You're about to hear my conversation with Tim Joel, portfolio manager with Mackenzie's North American Equity and Income Team and the lead manager of the Mackenzie Canadian Dividend Fund. Today, we'll talk about the case for Canadian equities in an environment dominated by geopolitical headlines. We'll go deep into the Canadian banks as well as the materials sector. And finally, we'll talk about what could surprise investors in Canadian equities over the next 12 to 24 months. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, Head of Portfolio Construction. Today, I'm joined by Tim Joel, portfolio manager with Mackenzie's North American Equity and Income Team and the lead manager of the Mackenzie Dividend Fund. Tim, thank you for joining the podcast today.
Thank you, Rajan. Great to be here.
Now, Tim, we are currently in an environment dominated by geopolitical headlines. So I think my first question is likely an expected one for you and for the audience. How would you describe the current state of Canadian equities in a minute to a client, given that the environment that we are in right now?
Yeah, thank you, Rajan. The Canadian market has been very strong. We've seen a period of very strong performance. 2025 saw great returns. The TSX Composite was up 30% plus in the year, far outpaced the US S&P 500 by almost 20% in Canadian dollars. And last year's gains were mainly driven by the materials sector, including gold, and the financial, namely banks in Canada. It may be a surprise to investors to know that the medium-term performance in Canada has been stellar. The TSX Composite has outperformed the S&P 500 on a CAGR basis across a 1, 3, and 5-year period. So, again, strong returns in Canada, probably unexpected to most investors. We generally remain constructive on the Canadian equity market. There's a lot of near-term noise and distortions being caused by the war, but we would expect that the underlying trends that were in place before the war do tend to continue after the war is over. We've seen that across many other war periods or economic shock type periods, and we don't think that this time would be any different. And that would generally favor the Canadian market.
Very good, Tim. I'm going to follow on where you were going there. You mentioned some of the conditions that were in place before the war began. Historically, Canadian equities have been viewed through a prism of perhaps being more value oriented. And certainly value was out of favor since growth led coming out of the financial crisis for a number of years, well over a decade. But why may that be the wrong lens to use today?
Yeah, a couple things there. I would say that that is a pretty accurate characterization of the attitude that there was towards investing in Canada for at least the last decade or so. Technology and growth had been working in the US and globally. Outsized free cash flow growth was being rewarded by the market, and capital increasingly flowed towards the stocks that had these characteristics and resulted in a continual re-rating of those securities for nearly a decade. The Canadian market was obviously less exposed to these types of companies and these sectors, and as you say, was more of a value or cyclical market that worked against the Canadian market benchmarks generally. Onto your question of why that might be the wrong lens today, I'll make a couple points on this. And I've been talking about this for quite some time. It's finally nice to see it come to fruition. The drivers of equity market performance tend to change over long periods, Rajan. The next decade of returns may be shaped by very different forces that we saw in the last decade. Typically in a market cycle, sustained outperformance tends to attract capital and excess capital. That can result in a misallocation of that capital over time. It also results in very high valuations. So a couple things, if we get a misallocation of that capital, which you may be seeing right now, given how much a lot of these companies are increasing in capital expenditure and resulting in a lower free cash flow, if you will, which the market had been rewarding for some time. And then those very high valuations can compress future returns. So we're mindful of that, particularly in the technology sector and across many of these growth investments. It very much is similar to what we saw in the tech telecom bubble of the late 90s, if you recall. There was a vast misallocation of capital at that time. There was a bubble, a very pronounced bubble, and that bubble burst, resulting in an underperformance of many of those old winners that were winners for a decade. On the other side of all this, you see neglected companies and neglected sectors. Very similar to today, we see that the resource side has been very neglected. We have not allocated capital generally to these companies, and that has resulted in a lack of investment in new commodity finds and commodity production, across many of those commodity sectors. Again, when we back up to the 2000 period, late 90s, after the bubble burst in technology, we saw Canada outperform for 10 years. The underlying reason was really because the commodity sectors have been neglected and unloved, very similar to today. And the banks had actually been very neglected and unloved, as well as growth investing was in vogue, value investing was not. So when I fast forward to today, there's quite a few similarities, and I think those secular trends tend to favor Canada today.
Very good, Tim. I want to stay on the Canadian banks. No conversation about Canadian equities, let alone Canadian dividend paying equities, is complete without a conversation of the banks. Maybe take a couple minutes to talk about the banks. They performed well, but I'm seeing more commentary from some analysts that valuations are getting a little bit rich. On the other hand, though, ROEs remain to be quite robust. How are you thinking about the opportunity and risks in the banks from here going forward?
Yeah, we've been long-term bulls on the Canadian banks, as you probably know, Rajan. Investments in the Canadian banks are very consistent with our overall style and philosophy as dividend investors. We look for strong risk-adjusted returns over time, and the Canadian banks have delivered that. I would say that over time, the Canadian banks have been proven to be prudent risk managers. They've shown very strong cost discipline over time, and they've been strong at capital allocators. They continue to invest in growth while also increasing dividends and capital returns to shareholders. Our Canadian banks are world class when it comes to comparison of banks around the world. This has resulted in an outperformance of Canadian bank stocks over time, and we're mindful of that. Having said that, we are currently tactically underweight the Canadian Bank Group. I think it's really a good example of how we manage risk in the fund. We are not buy and hold investors. When we look at Canadian banks across several of our approaches in our valuation framework, many of the banks appear overvalued. If you just look at a simple forward price earnings ratio, we see very elevated valuations. We've only seen the bank group trade beyond these PE ratios twice in the past several decades. One was in the late 90s when you had the merger mania going on, the potential for these banks to merge. And the other time was in and around 2006 when the banks were expected to spin off some of their businesses into high valuation income trusts. And again, we know both of those periods fizzled out and bank valuations corrected, not significantly, but did correct over time. So we see a similar situation today. We don't mind paying high valuation multiples if the growth environment allows for such. We don't see a very strong growth environment for the Canadian banks. Right now, we know the economy is under some pressure that will result in a slower growth in earnings at the Canadian banks. Again, we're not looking for a cliff event in earnings, or we're just mindful that the valuations have risen quite significantly.
Very good. Tim, let's move from the Canadian banks to what is front and center after being on the back burner for over a decade, the Canadian materials sector. Materials play a big role. Gold, in particular, has been significant with regards to performance in Canadian equities the last 12 months. Let's get specific, though. For those investors on the call, they're probably weighing exposure to gold through direct exposure to the commodity through a spot ETF, say, or through an ETF that has spot exposure, or through gold miners. So, how should investors think about gold miners versus just getting direct exposure to the commodity?
Yeah, it's a good question. Rajan, you're right. The materials sector is a significant part of the overall Canadian market, represents about 18% weight in the broad Canadian indices. I do have to back up here. Historically, we've not been big gold investors. The gold companies in Canada have had a mixed financial record. They've historically been poor capital allocators. They have not earned their cost of capital over time. They've been very highly levered and indebted, and they just haven't been strong dividend growers. Now, that had been the case in the past. But as I said before, markets change and investor behavior causes or forces management teams to change. And we've seen that change in the gold sector. These companies are no longer indebted as they'd been in the past. In fact, the gold companies that we own in the portfolio have a net cash position on their balance sheet. In other words, they're debt free. So that's a big change. I think it takes out the downside risk on the stocks, all else being equal, because the balance sheets are in just such better shape. In addition to that, the discipline has brought very strong free cash flow generation in this environment. Last year, the commodity price had averaged $3,400, and our companies generated a 20% plus ROE in that environment. Gold today, after a big correction, is $4,300, and we would expect very strong free cash flow generation from the sector. So we're mindful of that, and we're mindful that these management teams are looking to return capital to shareholders. That's what we look for. A good example of that might be Barrick. Barrick just raised their quarterly dividend 240%. They're paying shareholders a lot of that cash flow generation. The stock currently yields 4.5%, and we see the potential for other gold companies in the sector to do the same. The biggest reason to own the stocks over the commodity would be that return of capital as shareholders. These companies pay a dividend. The commodity does not pay a dividend. So that's a plus. And also, if you trust the management teams and their newfound discipline, there is operating leverage in their businesses. Last year, the TSX Gold Subindex was up about 100%, while the commodity was only up 66%. So there is operating leverage in the stocks that makes them more attractive than the commodity itself.
Very good, Tim. I've got a few questions left here that I want to fit in before we run out of time. So I'm just going to move along here. I am curious. We've talked about banks at the industry level, we talked about materials at the sector level. Let's go across sectors. Share with me your best one or two ideas right now.
We're overweight energy, Rajan. We had been overweight energy even coming into this war. We saw what the war has done to oil and gas prices. So that has been very beneficial to the portfolio. We think, if anything, coming out of this war and this conflict, you will have a premium in oil and gas as the globe or countries around the world think about energy security. We are going to need more energy around the world. And we recognize that early. And it's not just renewable energy that we will need, we'll need oil and gas as a requirement for energy. And we like the trends in oil. For everything that's been said about the decline of oil and the less in need of oil demand growth has been growing by about 1% annually for the last decade or so, even annually over the last 5 years. In a world where we're electrifying automobiles and transportation, that is still very strong oil demand. We have not invested in new finds and new production. So we still like the outlook for oil over time. And then on the gas side, the same thing. The world is short natural gas, and North America is long natural gas and natural gas reserves and the ability to produce natural gas. That gas will flow where it's needed, particularly Asia and Europe, in the form of LNG. And the companies that we are invested in Canada will be the beneficiaries of that secular trend. So we like energy. We do like our pipeline assets as well. You're going to need pipelines to transport all this oil and gas around North America and to our coasts so we can export more of this energy. The other area that we like are the copper miners. Again, coming back to the theme of electrifying the world, we are going to need far more copper than we are producing today. And our companies in the portfolio will be beneficiaries of that secular trend. So, not only is it electrification and the build out of AI and the required data centers going to require more copper, but so is defense spending. You can see the trend across particularly NATO countries, but also adversaries around the world. There's far more defense spending occurring and expected to occur, and it's very copper intensive. So we like the secular trends in copper as well, Rajan. Probably two of the thematics going on in the portfolio that we're invested in.
Very good. Now, just a couple questions left for you, Tim. Stepping back, you focus on picking excellent stocks each day. My focus is on portfolio construction. I'm curious from your take, why should investors listening to this podcast consider allocating to Canadian equities from a strategic perspective versus, say, owning more US or global equities as a function of any pullbacks they see in the market?
Yeah, very good. I think it starts with valuation, Rajan. If you look at the Canadian market, it's still relatively inexpensive compared to the US market. So the Canadian market, measured by the S&P TSX Composite, trades at 16 times forward earnings, whereas in the US, the S&P 500 trades at 20 times forward earnings. We think that that valuation gap should narrow as earnings growth is no longer outsized in the US market. In fact, if you look at consensus estimates for earnings growth in Canada, well, we're looking for earnings growth in Canada to surpass earnings growth in the US in 2026, while 2027 growth expectations are similar across both countries. So, that gap in valuation doesn't necessarily make sense to us. And we think you'll see a narrowing of that gap over time. That favors Canada. Another reason to consider Canada is just a difference in market composition that can add valuable diversification to existing US and global holdings. So, I think Canada needs a consideration in that sense. We've seen a prolonged period of a secular bear in commodities. And now there's evidence that we're shifting to a secular bull market in commodities. This, over the medium term, would favor the Canadian market. If you just look at energy in the Canadian market, energy is about 21% of the TSX versus less than 4% in the S&P 500. And the materials sector, as we discussed, is 18% of the TSX versus less than 2% in the S&P 500. So again, as commodities continue their trend, we think that'll favor Canada and the composition of the Canadian market.
Very good, Tim. Now, to conclude our conversation, let's talk about surprises. Specifically, what could surprise investors about Canadian equities over the next 12 to 24 months?
In the near term, as I said, the economic outlook for Canada remains soft. It can make a pretty strong case over the medium term for Canada and the outlook for Canada. We are waiting for a renegotiation of the USMCA agreement. And, there's a good chance that that renegotiation will be a nothing event, which would be positive. I think a lot of investors are expecting that agreement to be torn up, if you will, but that doesn't favor either country, Canada or the US. So we think there could be a positive development in the renegotiation of the USMCA. If anything, it gets the risk out of the way over the medium term. Also, the Carney government has outlined many new major projects that they are considering. And these projects could actually advance rather quickly once a final investment decision has been made, as the government has also promised an expedited permitting process. So we look forward to that. And I think that could help drive the economic growth outlook for Canada. Could also drive foreign direct investment into Canada, which has been much needed over the last few years. The other thing that we could see that would boost economic growth is an increase in deficit spending. I know that seems kind of perverse in some ways, but we have the capacity in Canada to actually increase our deficit spending over the medium term, particularly if it is for an investment in projects that will favor the economy over time. And we think that's the case. So that should be an unexpected positive. The other thing that I would expect to see is, the current immigration policy calls for negative population growth over this year and next. Obviously, that would result in a bit of a softening of the Canadian economy. We think that you'll probably see a revision to the economic policy or the immigration policy going forward that would favor skilled labor coming into this country as we'd seen in the past. And that could also be, a positive revolution, if you will, as we look out, over the next 2, 3 years.
Tim, thank you very much. Going to wrap up our conversation there. Want to thank you again for taking the time to join us today on the podcast.
Very good. Thank you, Rajan. Thank you all.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.